You are listening to chartingwealth.com for Wednesday, the 24th of June, 2015. How do we always start with IYY, which is the Total Market Index Fund? It tracks the total market. It's an exchange-traded fund. If those of you who don't know what ETF stands for, that's exactly what this is. Why don't we look at it first? Well, because it tracks the whole market, and here's what the whole market's been doing over the last 4 days. For those of you who are joining us via audio only, what we are looking at is two pretty good size green candles moving up on the price line. We also see a crossing over on the MACD, which is our moving average convergence divergence line. It is crossing through the signal line. It is the only real indicator that we look at. We try to keep it very simple here at chartingwealth.com. Simple but accurate is what we strive for, because what are we trying to do? We're trying to figure out if the market's moving up, down, or sideways. It has been moving up the last 4 days, and what we see happening is a crossing over of the MACD, which portends potentially a strong up movement in the long chart. That is the 2-day chart. Now let's drop back from the 2-day chart, see what's been happening for the 4-hour chart over the last 2 days. 4 days, actually. We have four 4-hour candles, and what we see starting on the 22nd is a topping out. We actually have in the morning a candle going up to a high of 108. That is followed by another candle that goes up about the same height, starts there and goes down. The next candle we actually have recorded going down, and then we have very much of an indecision candle ending the day. We can see our derivative oscillator is dropping off in power, and we can see on the 4-hour chart it appears that the MACD is actually starting to converge. Very interesting pattern that we see here. The market is either getting ready to move back up again or is topping out. Now, for the record, it is crossing over as it ended the day, going up on the 2-day chart. But let's continue to watch that very closely as the market opens and we start going through the day on Wednesday, the 24th. That is what the total market is doing. Now, let's drop back to the 2-day chart again and go to SPY, which is another exchange traded fund that tracks the Standard & Poor 500. What do we see here? We see where it bottomed out over a 4-day, actually almost a 6-day period, and then moved up on that 6-day, that 2-day candle back on the 19th of June, and we see a real push up in the market starting then, followed by the 2-day candle starting on the 23rd. What we actually see is a moving together, a converging, that is a coming together of the MACD and the derivative oscillator. Those are the light red boxes that we see behind the moving average convergence divergence. We see those losing power, and we see an actual move up as these are approaching, but again, we still don't have a crossing on the MACD at this point. So as we continue to watch, we have tried to draw a trend line. We don't have a crossing over officially on the S&P 500, but it does appear that it's trying to get close to that. Now, if we look at the 4-hour chart for the S&P 500, we see a similar pattern. Actually, it had a much higher day on the 18th in the afternoon on the S&P 500, and then it has dropped off since then. We can see that the converging, the coming together of the MACD appears to be taking place on the 4-hour chart after it crossed over going up between the 16th and the 17th. So what do we have here? Well, we have some indecision it's showing at the end of the day, and we have what appears at this point to be a topping out. But again, no crossover going down. However, the SPY is still in officially, because we look to the 2-day chart. It is officially in I dropped to the 3-day chart there. Didn't mean to do that. It is officially in a down move at this point. It has not yet crossed over going up on the big wave. It's not pushed through the 30 and the 34 period moving linear regression lines. So we will continue to monitor and see what it does as the week moves on. Officially for the day, the SPY was up a mere 0.08%, not even 0.1% up for the day. Now, let's go back to the charts and move over to the Qs. What is the Qs? That's the Nasdaq 100. Again, another ETF. It tracks the Nasdaq, the tech stocks. What do we see here? Well, again, we see a pattern that's similar. Two big two-day candles moving up. We see a coming together, but not a crossing yet of the MACD, so we don't have an official up move yet. We see the derivative oscillator losing steam. It's a red candle still, but it's getting smaller. But when we explore further, what do we see on the 4-hour chart? Do we see the same topping out? Yes, we do. It appears that, again, we've got 4 candles representing the last 2 days, 4 4-hour candles, 4 half-day candles, which of course is 2 days, showing us again that we are topping out as far as those candles appear. Now, could it surge back up again tomorrow? That is possible, but again, it will be interesting to watch. Usually when you see patterns like this, it shows a topping out. Now, it could just be the market digesting the previous strong up moves, and it's just attempting to figure that out, digest it, and then surge forward again. But what also happens sometimes when you eat a big meal, you go to sleep and you lose energy. So we'll have to just see how this plays out in the morning. Very interesting what we have seen setting up. We don't have a confirmation of an up move yet. We have no crossover on the MACD. We don't have that much energy. But and also, if you look on the 4-hour chart, you can see that the derivative oscillator has been losing its steam. Now, could it turn around and move back up? Yes, but we want to just continue to watch and see what goes on. Remember, the charts can either go up or down. They can slide sideways for a while, but it's typically a binary decision, a 0 or a 1, an up or a down. So let's continue to monitor. Now, we're going to go to the 2-day chart on gold. Gold was officially down 0.66% today. It crossed over just back between the 17th and the 19th, going up. Actually crossed over very strong, and we had a very strong up move on the 19th in gold. And then what has gold done since then? Well, it moved down very strongly over the last 2 days. And if we explore that further, you all will remember how I spoke about the tweezer top that we saw back on the 18th. We saw a strong up move in the morning, then we saw a down move in the afternoon, followed by another up move that didn't go much higher, hardly at all, than the previous day. This was the morning of the 19th, and then a down move that afternoon. And again, whenever you see the pattern of a green candle followed by immediately by a red candle that is at least half or more of a move down on the previous up move, you see that as very much a bearish move. That means a losing of steam and energy. We saw it followed by, like we said, a green candle. It was a green candle, red candle, green candle, all topping out at about the same height, followed by a red candle at the same height, and then strong down moves over the last 2 days on the 4-hour chart, actually going from a high back on the 18th and the 19th of around 115.50 or so, and a strong movement down to 1293. So a strong move down. The 4-hour chart crossed over going down on gold. The derivative oscillator surged significantly going down. And again, when we go back to the 2-day chart, what we see is a strong breaking of the 2-day trend line, and it looks like gold crossed right back over. So that surge that we saw last week, actually represented by, if you will recall, the Fed coming out and saying that it wasn't going to do anything with monetary easing at this point. It was going to allow, well, with the interest rates, increasing the interest rates, it would continue to allow the monetary easing, that is, the quantitative easing, the low interest rates, all that. It would later in time look at adjusting the interest rate by just a little bit, surged this great up move, crossed over the MACD in a day going up on the 2-day chart, and then gold seemed to think better of it so far and has crossed over just a couple of days later going down. So important to continue to watch gold and see where it's going to finally end up. It has broken the 2-day trend line, so gold is officially in a down move on both the 2-hour, the 4-hour chart and the 2-day chart. Now again, what is happening this time of year with the market surging back and forth? What have we talked about since May? Sell in May and go away, that old adage where a lot of the volume leaves the market, the big money goes on vacation. Some literally, the people controlling the big money go on vacation. And what happens with the market is you start seeing a herky-jerky action. You don't see nice, clean, long moves like you see during the big 6 months that end, of course, in May. What you end up seeing is the market with a lot less volume, being more volatile, and not giving us as clear a signs as we typically see on those good 6 months that end in May. So that is where we are. Again, the beautiful thing about being non-professional traders is that you don't have to trade until you get strong signals that you're comfortable with. Then you can buy, then you can sell and make money and feel good about it. Again, thank you so much for joining us. Please follow us on Facebook and Twitter. Well, again, we are chartingwealth.com. You can just look up Charting Wealth on Facebook and Twitter and find us. We love your comments, suggestions, and everything you have to share with us. We're happy to share with you. Please make sure to tune into our training. God bless. We wish you the best in investing as the market kicks off on Wednesday, the 24th.